Welcome to the question clip on Chapter 4, and the question that we're going to discuss today will be question 4.23 in your question book, where you can follow if you want to. Let's just start by reading the required part so that we know what is required from us. They tell us to analyze the transactions and complete the table below. In this table, you'll see we deal with the whole accounting process, starting with source documents. You have to identify the subsidiary journal, the account debited and credited from the general ledger, as well as an analysis of the basic accounting equation. The first paragraph of this question informs us that the following information on unrelated transactions is available. Assume that the control system is used for debtors and creditors. Very important to note, unrelated, so the information from one transaction will not influence the other. And then they tell us to assume a control system. Therefore, we're going to account for transactions regarding debtors and creditors in both the control accounts and in the individual debtors and creditors ledger accounts. In the transactions that will follow, you will see that they mention the periodic and the perpetual inventory system. So this is revision to see whether you can identify the differences between the two inventory systems and cope with transactions like that. Then we're going to start. Transaction number 1. Purchased inventory on credit from ABEs at 30,000 Rand, subject to 20% trade discount. Trade discount is the on-the-spot discount, different from settlement discount, and they tell us that the periodic inventory system is in use. Periodic inventory system, if you can just remind yourself, we do not keep track of the inventory transactions in the inventory account, but we're going to use alternative accounts for the periodic inventory system. So if they mention that we purchased the inventory on credit and we want to complete our table, the source document for a credit purchase will be an invoice. And we also have to indicate whether this invoice is the original or the duplicate. The original or duplicate will determine the direction of the transaction, either a purchase by your entity or a purchase from your entity. So in this case, because we entered into the purchase transaction, the supplier would have provided us with the original invoice. This will be entered in the purchaser's journal. Remember, it's the periodic inventory system. So we're using the purchaser's journal. Our account debited and credited, because we purchased inventory, you would want to influence the inventory account, but this is not the perpetual inventory system. This is periodic. So we replace the inventory account with the purchaser's account. And our account credited, because it was on credit from ABEs, we'll have to include both the creditor's control and the name of the entity from which we bought, one for the general ledger and one for the creditor's ledger. Now, the amounts that we're going to analyze in our basic accounting equation will not be the 30,000. This 30,000 is the amount of the inventory, the value, but we receive 20% trade discount. Now, if you can recall, whenever we get on-the-spot discount, we do not account for the discount separately because we're only going to settle the amount after the discount. So now we have to do a calculation where we take our 30,000 Rand value of inventory, and we want to deduct from that 20% discount. Now, if this was the 100% for the inventory value, and we want to deduct from that 20% trade discount, we are actually looking for 80% of this value. So we can just multiply the 30,000 with 80 out of 100. So if we can quickly look at our calculation, 30,000 Rand times 80 divided by 100, and that will give us the amount, the historical cost price for which we need to account. And that 24,000 will increase my liabilities. I owe the creditor more. And then because purchases is seen as an expense, not an asset like inventory, we're going to have to include that under equity. And if we debit an equity item, that will be a negative under equity. The second transaction, unrelated. We sold goods with a cost of 600 Rand on credit to B-Brain. The perpetual inventory system is in use, and remember, perpetual inventory system, we keep track of inventory in the inventory account. So whenever there's a transaction influencing inventory, we need an entry in the inventory account as well. It's used, and the goods were sold at a gross profit of 25% on the selling price. Okay, they provided us with a cost price of goods, but we sold the goods, and the customer will never know the cost price of the goods. Therefore, we have to convert this cost price to a selling price before we can enter any amounts into our columns of analysis. So we are working with the 9 blocks, and they told us that the gross profit is 25% on selling price. So we need to determine which of these 3 we use as the basis. And if it's on selling price, the selling price will be 100% as the basis. Profit is 25%, therefore our cost price will be 75%. In this particular question, they provided us with the cost price of the goods there of 600 Rand. So the known item here is the cost price of 600 Rand. And now we can go over to our calculation of the selling price. Percentage-wise, we are looking for selling price, so that will be 100 divided by, they provided us with the cost price, so we've got the known item there at the bottom of 75% times the 600 Rand, and that will give us our selling price that we can use in our accounting entries. Just for our calculation, 100 divided by 75 times the 600 Rand, and sorry, let's just redo that, finger troubles. 100 out of 75 times 600, and that will give us the 798 selling price. If we now account for this, we include it in our table, analyzing this transaction. Because we sold goods, this will be an invoice, again, that we use as our source document, but in this case, we're issuing the source document, so we are going to be left with only the duplicate. Can you see that the direction of the transaction is determined by whether it's original, that was purchases, or duplicate, that was a sales transaction? This will be entered in the debtors journal, and now we need to account for not only the selling price, but also the cost price of the goods, because in this transaction, they told us we're applying the perpetual inventory system. So let's first deal with the selling price, which we calculated. We're going to debit the debtor, because this was a sale on credit. Debtors control, because it's the control system. And we again indicate the name of the debtor as well. The account that we credit will be sales. And now we can only work with the selling price. The debtor will owe me more. So I'm going to increase the debtor's account with the 800 Rand. And for sales under equity, increase in my profits, 800 Rand. If we just kept it at this, we would not have adhered to the rules of the perpetual inventory system, because something happened to inventory as well when we sell. When we sell the inventory, it will have to decrease, so we're going to have to credit the inventory account and debit a corresponding expense account called cost of sales. The cost price of this transaction was given as 600 Rand, so our inventory will decrease with the 600 Rand. And our equity item, cost of sales, will decrease our profits with 600 Rand, resulting in our profit being accounted for under equity, the difference between the sales and the cost of sales. Transaction number 3. We received goods returned by debtor K. Khan. The goods were taken back into stock at its cost of 360, so they again provided us with the cost price of the goods. The profit markup is 20% on cost, and the perpetual system is in use. Perpetual system, keeping track of inventory in the inventory account. So whenever we have a reversal of a sale, because this is goods returned by a debtor, we'll also have to reverse the cost price of the sold items through the inventory account and cost of sales. They provided us with a cost price again, and now our profit markup is on cost. So in our 9 blocks, if we have to do our calculation, we can now determine that the basis is the cost price. They mentioned 20% on cost, profit 20, so the selling price percentage-wise will be 120. They only provided us with a cost in monetary value of 360 Rand, so we now need to convert that cost price to a selling price before we can enter our transaction. We are looking for the selling price again, so that will be 120% out of the cost price, which is 100. And if we multiply that with our cost price of 360, that will give us our selling price that we can account for. So we have 120 divided by 100 times the 360 Rand, and that will give us our 432 Rand selling price, which we can now include cost price and selling price. 2 separate sets of debits and credits, one for the selling price and one for the cost price. Source document. This was a return by a debtor, so whenever we have returns, we're going to have to either issue a credit note or receive a credit note, and that's why we have to indicate whether this is a duplicate or original. We will hand the original credit note to the debtor as acceptance of the returned goods, and we will be left with a duplicate. This will be entered in the debtor's allowances journal. And now, if the debtor returns, that person will owe us less, so we have to credit the debtor's control account and the individual debtor's ledger account. And instead of reversing this against the original sales account, we're going to keep track of the sales returns in a separate account called debtors allowances. And this will assist with internal control as well as quality control of your products. In the debtors account, we always use the selling price, because remember, your clients will not know about the cost price. So the debtor will owe me less. So I'm going to decrease the debtors account under assets with the full selling price of 432. And I'm going to cancel the sales under equity, 432. Cancellation of income will be a minus there. Then we also take the inventory back into our storeroom. So we're going to have to increase the inventory account and cancel the corresponding cost of sales because of the cancellation of the whole sales transaction. So in my inventory, I can only work with the cost price. I'm going to increase my asset with 360 Rand. And now I'm going to credit an equity item. And credits in equity is a positive. That means that I'm cancelling the original expense for the cost price of the sales with an income item of 360. It's just a cancellation. Transaction number 4. We paid a creditor, T. Twain, 285 Rand per check in full payment of our account after 5% settlement discount was taken into account. You need to read carefully. The English here can be confusing, especially if it's not your first language. So we're going to go through it again because you have 3 items that you need to look at here. You need to look at the full account, you need to look at the payment amount, and the settlement discount. Any one of the 3 can be given in a monetary value, and we need to be able to calculate the others. They tell us we paid a creditor, T. Twain, 285 per check. So that 285 Rand represents the payment that we made. This is in full payment of our account. Now, our account is at this point unknown to us, but this payment was made after 5% settlement discount was taken into account. Therefore, this 285 is not the full account, but only the payment. If we can look at a mathematical calculation of the amounts that we have to use, the full account of the creditor, full is 100%. We did, however, receive 5% settlement discount. Therefore, our payment only represents 95%. This payment of 285 Rand was after the 5% settlement discount. If we then want to calculate the full account, remember we use our formula, what we want, divided by what was given to us, which is now the 95%, times the 285 Rand. And if we do that calculation on your calculator, that will give you the 300 Rand as the full account. If the full account was 300 and we made a payment of 285, that will result in our settlement discount of only 15 Rand. You could also do a calculation of this. 5 out of 95, the given amount, times the 285, and that will give you the same answer. So if we can now go over to including this in our table of analysis, they mention that we paid a creditor by check, so our source document will be the check counterfoil. And whenever we make a payment, we include that in our cash payments journal. When we make a payment, the amount due to the creditor will decrease, and the creditor is a liability, which will decrease on the debit side. So we're going to debit creditors control. And remember to include the name of the creditor as well. And now we've got 2 credits adding up to this one debit. The one was the cash payment that we made, and the other one was the settlement discount that was granted by the creditor. So in our books, it will be settlement discount received. Let's just include the amounts. The creditor's control, that creditor will owe you, you will owe that creditor not only the cash but also the settlement discount less. So we can add the 2 amounts, the 285 and the 15, and that will be my decrease under liabilities. I will pay part of that in cash. And then the settlement discount received, that is like a benefit to you, which will increase your equity. And after this transaction, your basic accounting equation will still be in balance because the minus 285 will be equal to negative 285 on the credit side. Transaction number 5. We issued a check to Help You Bank as payment of the half-yearly installment of 5,000 Rand on the loan, as well as 10% per annum interest for 6 months on the outstanding balance of 55,000 Rand. So we do not only make a payment of the installment, there's the installment amount, but we also pay interest 10% for only 6 months, and that is based on the 55,000. Now they tell us we have to assume that the bank has an overdrawn balance here. Bank having an overdrawn balance will influence my analysis of the basic accounting equation at the bottom here, because overdrawn bank balances will be classified as liabilities and not as an asset. So if we make a payment out of this already overdrawn bank account, that will imply that we owe the bank even more money. Therefore, my liabilities will increase. They give us the amount for the installment, but they do not give us a monetary value for the interest. So we're first going to go over to the calculation of the interest on the loan. The outstanding loan amount of 55,000 Rand at the interest rate of 10% that they mentioned, and this is only for 6 months. If this is an annual rate, we have to apportion it for the amount of months for which we make the payment. Let's see if we can get to that calculation. 55,000 Rand at 10% for only 6 months. And that will give me my interest payment of 2,750. So I'm going to include this interest as well as my installment of 5,000 Rand. So my total payment here will be accounted for as the liability in bank. If we complete our table now, we made a payment with a check. So I will again have the check counterfoil as my source document. This will be entered in my cash payments journal. The bank will decrease with not only the installment, which we can take off from the liability, but also with the interest. And this is interest expense. Remember to specify, because you can have interest income as well. The interest that we calculated as 2,750 will be entered under equity, and because it's a debit entry, will decrease my profits with 2,750. The installment of the loan from the bank will make us owe Help You Bank less, the 5,000 Rand. But now because bank over here had a unfavorable balance, it was overdrawn, I will also owe, in terms of my current account, the bank 7,750 Rand more. Transaction number 6. The bank returned a check of 245 Rand marked insufficient funds. So you gave this check to the bank after receiving it from the debtor, and now the bank has returned it, saying there was not enough funds in the account of the debtor. The check was received from debtor Bosch in settlement of his account of 260. If you can recall the previous discussion on the account and the cash and the discount part, here that comes into play again. The full settlement of the account was 260. So if the account was 260 Rand, of which I only received 245 Rand in cash, that means that I grant a discount at that stage to this debtor of 15 Rand. And now because the check was returned, therefore it's not a valid receipt. That's our cash part. Not a valid receipt anymore. I will also have to cancel the settlement discount. So if the bank returned the check, my source document will be the document issued by the bank, which will be a bank statement. That will be the first time that you know about it. We received 245 Rand originally from the debtor. That would have been entered in the cash receipts journal, and the opposite of a receipt is a payment. So the cash part can be reversed in the cash payments journal. So the debtor will owe me more. Debtors control / the name of the debtor will owe me that cash amount again. So that will be the 245 Rand, with which I need to increase the debtor. But that's not the only thing that I have to reverse. I will also have to reverse the settlement discount part. In the cash payments journal, we do not have a column for settlement discount granted. Therefore, all these transactions that cannot fit into the general journals generally used, will have to go into the general journal. And the debtor will also owe me that settlement discount amount again. So now I just need to indicate which part was cash and which part was settlement discount. So the cash part will go to bank, and the settlement discount granted will now be reversed out of my equity. They do not mention that bank was overdrawn, so bank is still an asset. So if I credit the assets, that means I cancel that receipt because it was not valid. He did not have enough money. And I also have to reverse the settlement discount that I granted. Remember, when you grant discount, it will be an expense, but this is a reversal of the expense, increasing the equity. Our last transaction. The owner took goods with a cost of 220, selling price of 340 for his personal use, and now the periodic inventory system is in use. Periodic inventory system, we do not keep track of inventory in the inventory account, but we do keep track of inventory in alternative accounts. For the periodic inventory system, we're therefore going to cancel the purchases of the entity from that expense account and take it to the owner's accounts. For the owner, we either have capital contributions or drawings, and in this case, the owner took goods, therefore we will have to include it in his drawings account. If we just have a look at the source document quickly, the owner took the goods, and that will be entered in the general journal. The source document for general journal will be our journal narration. That's a description of the transaction so that you can go back if you need to. The owner took goods, therefore the equity will have to decrease on the debit side. So we're going to debit the drawings account of the owner. And we're going to take this out of the expense account in which we include it. And in this purchases account, we worked with the cost price when we buy goods. So for drawings of the owner, we can also only account for the cost price of the goods taken. The drawings will result in a negative entry under equity. And then the purchases is a credit. That means it's a move from the expense, and to move it out, you'll have to add the 220. That is a nice summary for Chapter 4. I hope you learned a lot from this question clip and look forward to seeing you in the next one.